To discuss why they are at the optimistic end of the spectrum when it comes to what they expect from a portfolio of global bonds in 2025, I'm joined by the co-managers of the Nedgroup Investments Global Strategic Bond Fund. They are David Roberts and Alex Ralph. David, let's start with you. You launched this fund just over a year ago. So tell us, how was 2024 for investors in the portfolio? What did you learn about bond markets?
Thanks, Mark. Yeah, well, Alex and I have been doing this for a long time, so we did learn a bit, but in reality, 2024 played out pretty much as we expected. I think a lot of people expected really great things from the bond market, whereas what we'd said was it would be a constructive year, but one where the majority of returns came from income, really, and that's indeed how it played out, despite all the hand-wringing in some quarters.
And Alex, in the first year, the fund had a total return of roughly 5%, but how much risk did you have to take to produce that level of reward?
Yeah, a lot of that return basically came from spread compression. So credit in particular had a really good year. Government bonds were a lot more volatile. So some of the return came from trading that volatility by moving duration around, depending on how many interest rate cuts the market had priced in. But a lot of it also came from credit compression. So our positions within European investment grade particularly paid off, but also some of our high yield stock selection. We had a good year in some of the stock picking as well.
Before we move on to your views on 2025, you've been working together for about a year now. What have you discovered as running through this sort of fairly new partnership? Alex, let's get your thoughts on that first.
I think there's been a decent amount of discovery about how we trade. When we first met, when we discussed how to bring the portfolio together, there was a clear alignment in how we had previously run funds. So actually nothing really has changed on that level. But I'd say the tactical moves that we make within the short term has been good in terms of eking out those extra gains. But overall, I'd say it's kind of gone how we expected it to go in terms of portfolio construction. And in terms of the strategic and tactical element of the portfolio.
I would echo that. I mean, I think, people talk about top down and bottom up, and they say, oh, David, you focus on top down and Alex bottom up. But we certainly think of the portfolio as a single portfolio rather than a combination of top down and bottom up. And we work very closely together to try to ensure that the best of each of the top down and the bottom up characteristics are married together in the portfolio. And that's certainly, I think we've both enjoyed that aspect of it. But as Alex said, we were aware of each other, of each other's styles of how we've managed portfolios for a long time. So, it was, we had a strong understanding of what we were each going to get from each other, I think.
I guess certainly at least ever since 2008, we've been in this period of great moderation, very low interest rates. I mean, fundamentally, is that all over now? How much of your previous track record and experience can you fall back on now that rates are that much higher?
Yeah, so we very much talk about going back to the old normal. Unfortunately for us, we actually experienced that pre-2008. So we know how much, as we saw in 2024, how volatile rates can be. And we actually prefer trading in that environment. It gives a lot more opportunity. The QE era kind of allowed blanket compression of risk and rates, and therefore wasn't a very exciting time to be a bond fund manager. But we much prefer it now with the extra volatility, the fact that rates finally reflect the economics that we're seeing out there. Unfortunately, on the credit side, 2024 was incredibly dull, but we're hoping for greater spread volatility within credit so we can use greater implementation of our tactical and strategic plays.
And David, there's does seem to be just a lot more debt out there now than there was pre-2007-8. I mean, at the very least in the government space. I mean, does that throw up any particular challenges for you now that didn't exist?
Well, I would say there are lots of different types of debt, Mark, some of which we just avoid completely. So we are core markets. So if you look at the global index, about 10% of that now is China, so the global aggregate bond index. Local currency Chinese debt, we don't do that. We also tend to avoid anything that's local currency emerging markets. We avoid the lower reaches of high yield, and we certainly don't go anywhere anything that could be described as a private market. So there are great big chunks of the market which are new really to the world in the last 15, 20 years, which we don't invest in. And as Alex has mentioned, the volatility and the opportunity in those core markets, not least thanks to Donald Trump, we think is something we can continue to exploit in 2025.
Well, on that point, I mean, if you're looking at the government bond or the rates part of the market, what are some of your observations at the start of 2025? What are the things that you think you can take advantage of?
Yeah, that's a good question. Again, I take advantage of from a client perspective. And the starting point, I think, for clients in fixed income almost always is the key. So what that means is, what level of compensation are you going to get from bonds if nothing happens? Now, 2 or 3 years ago, we were struggling to see any positive opportunity in bonds in terms of just that natural return in the market. But now we do think that the starting point, because yields have risen quite a bit, is attractive for certainly medium to long-term investors. And also, I would say there's a fair chance in the short term we can see a bond rally too. So that starting point, that higher level of yields, which gives significant compensation, certainly relative to inflation, we think stands investors in very good stead indeed.
And Alex, looking at the credit market, I think you said 2024 was quite a dull year for credit. So where do you see some of the potential excitement?
Yeah, it was dull mainly because the fundamentals justified it being dull, to be honest. But we think that essentially there is tail risk building. One of them is the private credit space. Default rates within high yield have been held pretty low, mainly because a lot of the companies that would have come to high yield have gone and financed themselves in private credit. We think there is a tail risk possibility that default rates that haven't really been shown to the market will come through the private credit. And because they're kind of marking their own homework, shall we say, we think that could be a problem for clients who have gone into that space and don't really know what they're seeing on the underlying assets. And then secondly, I think there could be a problem with economic growth outlooks. So people are assuming that US economy will handle this kind of volatility we're seeing around tariffs and a weakening job market. But any kind of weakness there, then we think there will be a knock-on effect to credit, because essentially people are positioned all the same way within credit. They're very much positioned for the continuation of credit, and any kind of reversal in demand, we do think will have quite a dramatic impact on spreads.
So if there are those two potential downsides in the market, how do you position yourself to make sure that, you know, if those took place, you wouldn't be harmed by it, or at least there would be minimal damage to the portfolio? Yeah,
so we're trying to contain the damage essentially by investing for carry rather than compression. So we don't really believe that credit spreads will compress any further. They're at their post-global financial crisis tights. So we're positioning for carry, which in other words, we mean we're positioning defensively. So we prefer the utilities sector that wouldn't be subjected to the same volatility you'd see on the economic cycle. We're also positioned in the short end of the credit curve, where you are cushioned against any kind of spread widening to a far greater extent than if you went further down the credit curve. So we're sticking to short-dated credit.
And Deb, going back to the government bond markets, what are the opportunities? I mean, I suppose particularly now, if you look at the G7, the central banks have got a variety of policy responses. They're not all positioned in unity. So, what does that throw up for you?
Yeah, I mean, Alex and I spend a lot of time talking about this. The first and most easiest thing from our perspective is Japan. So you mentioned this idea of G7 central banks not all necessarily moving at the same speed, and also some of them are moving in the opposite direction. So Japan we've zero exposure to at the beginning of 2025 because the market just looks too expensive. The Central Bank of Japan likely to raise rates. But once you move into the rest of the G7, effectively we've got the European bloc where we're likely to see the ECB cut rates, leaving the great unknown of tariffs aside. There's still enough challenge to the European economy as it is that the ECB will likely cut, which should be good for bonds. The UK is a little bit in no man's land, perhaps, but when we look at the North American banks, Canada, has been well trailed again at the start of 2025 by the problems there. But in the US itself, the expectation is even if we do see some inflationary pressure as a result of Trump's tariff policies, the odds are that inflation will actually fall this year in the US. So again, if you're starting with a yield of about 4.5% in treasuries and inflation's falling probably quite close to 2% by year end, that's a really nice opportunity for most investors.
And Alex, a core part of the market for corporate bonds and high yield bonds is traditionally has been financial. So if you look at that as a sector, how robust does it feel to you? Are there particular parts of it that you want to be in, particular parts you want to avoid?
So financials themselves have had a really sweet spot over the last couple of years as interest rates rose, their net interest margin expanded, and they're in a lot kind of healthier place than they were at any point in the last 20 years, really. But we do want to avoid UK financials. The reason for that is because any kind of volatility we'd see in the sovereign gilt market, we think has a knock-on impact on financials. For example, if you look at last year when French went through that volatile time around their summer elections, French financials underperformed the rest of the European market and continue to do so up until the year end. So we think that UK financials are vulnerable to sovereign correction. We prefer Nordic and global banks, and any kind of systematic sell-off, they tend to outperform. So again, it fits that kind of defensive carry play that would rather be in those geographic areas.
We'll get a final thought from each of you around the markets. What if your thesis is wrong? So, David, if the world doesn't pan out the way you're thinking about at the moment, how quickly can you turn things around? Sort of, what are some of the counter bets that you've got in the portfolio?
We can turn the portfolio around very quickly. We are in large liquid markets, and honestly, it would take us minutes to reassess our portfolio and to realign it. I would say that our core view is that we see a similar level of return to last year, but again, Alex mentioned this idea of the tails of the market. And there certainly are quite a high probability returns are materially better. And if we do move into that world, then it's pretty straightforward for us to increase the maturity profile, to take more risk through the credit side.
And Alex, just picking up on that, what are one of the two of the things that you're keeping an eye out for, which will either confirm you in the views you've got at the moment or might make you think it's time for us to have a little reassess here?
So I think on our outlook here, we're saying we don't believe there'll be any compression in spreads. If we're wrong, because of the starting level, as David talks about, starting level is key, we don't think we'd be wrong by very much, because there's very little move for spreads to compress anyway. So I think that we will look out for maybe opportunities to actually trade credit a lot more this year. So 2024, we didn't really move the asset allocation particularly much because nothing really changed. But this year we're hoping for a pickup in volatility in credit so that we're able to asset allocate and move the asset allocation around a bit more. And so we're hoping that there will be credit fundamentally can trade quite aggressively both ways. So we are hoping that there will be opportunities to maybe pick up some particular names at a cheaper level when the market starts to panic. And we've already seen this year a little element of panic, but we're hoping that will continue in further bouts as the year goes on.
And just on that point about credit spreads being very tight over government bonds, David, do you think that's fundamentally because everyone's too bullish about the outlook for corporates? Or do you think it's actually the market telling you that with all this debt out there, investors are really very, very nervous about the security of government paper?
No, I think that there's an awful lot of money around for assets in general. Liquidity is fantastic in most asset classes. I think hardly a day goes by when we don't hear about someone else taking the profit in the Mag 7 and looking to invest in another asset class. Again, defer to Alex, but most corporate balance sheets, certainly the nature of the companies that we look at, so they tend to be a large to mega cap, are in good shape. Yeah. And as Alex said, it's not really the fundamentals that we're that concerned about, it's more the valuation. I would say in the government bond side, it's arguably the opposite. The valuations are good. The fundamentals, so core economics, are deteriorating slightly, which for a G7 government should be a positive for sovereign debt. But there's a little bit of a suspicion in the market that inflation's going to hang around for even longer than some have thought. And I do think that together with the uncertainty around the US fiscal policy is a big part of the reason why government bond yields are not lower, Mark.
And finally, the fund has just completed its first year. So 12 months down the track, are you confident that you've delivered what you promised to investors when you first launched, Alex?
I think so. We said that we were going to run a core defensive global strategic bond fund, and the performance relative to the risk that we took and really has reflected in that. And that's essentially what we've done, and we expect to do that for the next 12 months.
David, this fund has the tagline core, nimble, proven. Prove it.
Well, as Alex said, we're 12 months or nearly 13 months now in, and we believe that we're delivering what we promised, so stability and an inflation-beating return without taking too much risk. When we have decided that we wanted to change something in the portfolio, be it duration, be it asset allocation, there is no investment committee. Alex and I decide, and then we implement. So that's done very efficiently. So I would say we're extremely flexible, extremely nimble in that respect. And then finally, as I say, core markets only, high quality government bonds, quite a large weighting to core, well-known investment grade names, and a smattering of the better quality parts of the high yield market. And that's it.
We have to leave it there. David Roberts, Alex Ralph, thank you very much.
Thank you.